The term leverage in finance comes from the use of leverage in the real world. Just like if you use leverage, you can lift heavier objects than you usually would be able to. When you use debt for your investments, you will be able to achieve higher returns than you normally would be able to. Consider this. If you have an asset that is worth $100 and you buy it with $50 of your own money, but the other $50 are taken as debt, you have the following situation. Let's say the interest on your debt is 5% and the asset goes up by 20% to $120. Well, in that case, your asset will be $120. When you pay back your debt with the interest, you will return to the lender $55, which leaves you with $65. This means that you made a profit of $15. $15 is 30% of the original $50 you started with, which is a 50% bigger return than if you had just bought the asset with $100 of your own money, because then you would have made 20% when it goes up to 120. This is essentially how this works with every leveraged product. As long as the conditions are good and the assets are growing more than it costs to borrow the money, everything is sunshine and rainbows until it isn't. Because in our previous example, if the asset doesn't go up but down 20%, basically from 100 to 80, then what happens is you still owe 55 to the lender. That leaves you with $25 from your original 50 you put from your own money, which is 50% loss. However, if you had bought the asset with your money entirely, then you would have only lost the 20%.